Hello, Namaste, welcome. In today's video, I'm analyzing Motherson Sumi. We'll go through the company's profile first, then we will move on and look at the detailed financial statement that would include profit and loss account, balance sheet, cash flow statement, and quarterly P&L account. From there on, we'll look at the peer group comparison, and finally we will look at the chart where the price of this company is, and based on RSI, what levels can we buy into this company. Finally, we'll look at the fundamental intrinsic value based on certain projections of the past. So starting with the company's profile, Motherson Sumi Samvardhana Ltd is a flagship company of Samvardhana Motherson Group, SMG, a leading global automotive component supplier. The company has a diversified automotive product portfolio which includes automotive vision systems, wiring harnesses, polymer parts, tooling, metal machining, and elastomers, spanning key automotive markets around the globe. The company was promoted in 1986 in technical and financial collaboration with Sumitomo Wiring Systems and Sujitz Corporation. Motherson Sumi is a listed entity with its promoter shareholding distributed between Samvardhana Motherson International and the Sehgal family, holding approximately 36.6% stake, and Sumitomo Wiring Systems holding approximately 25.1% stake. Motherson started out as a single product having wiring harness portfolio, but has since expanded its product range to include polymer products, that is leather based products or plastic products, automotive mirrors, and machined metal components. Besides organic growth through investments in identified geographies, the management has followed an acquisition-led growth strategy, which has helped the company diversify its operational profile over the years. The company is generally expanding itself through inorganic growth, that is growth through acquisition of other companies. The wiring harness business of the company is housed under both Motherson Sumi on a standalone basis and its subsidiary PKC Group, a French company acquired by Motherson in 2017. The rearview mirror business is housed under SMR, acquired in 2009. The largest business by revenue is the interior and exterior polymer products, which contributes approximately around 50% of the overall revenues, and these are largely housed under SMP, which was acquired in 2011, and Samvardhana Motherson Radel Company, SMRC, acquired in 2018. Motherson is one of the leading automotive component companies globally and a supplier of wiring harness, rear view vision systems, and interior and exterior modules to large global auto OEMs. Company has a healthy market position in terms of global presence as well as share of business of its product. The company's polymer business through SMP is a leading supplier of bumpers, cockpit assemblies, and door trims in the premium segment with a sizable global market share. Samvardhana Motherson Reflectech SMR subsidiary, the company's mirror business, enjoys a dominant global market share for exterior mirrors. At a standalone business, Motherson, along with its joint ventures, enjoys a dominant position in the wiring harness segment for the Indian passenger vehicle market. Likewise, the PKC Group has a strong presence in the medium and heavy commercial vehicles in North America and Europe. Aided by the acquisition of PKC Group in 2017 and SMRC in 2019, the company's revenue dependence on European original equipment manufacturers and the Volkswagen Group, VW Group, has moderated to approximately 29% in the first half of 2020. The same is likely to moderate further, aided by ramp up in scale of operations of new plants set up by Samvardhana Motherson Automotive Systems Group. Although a moderate dependence on the Volkswagen Group results in high concentration risk, the same is mitigated to a large extent by the strong share of business enjoyed by Motherson across various model programs. The company has a widespread geographic footprint with plants located across geographies. Over the years, the company has proceeded to set up manufacturing facilities in close proximity to the original manufacturer plants, thereby integrating into the OEM's supply chain and offering just-in-time logistics. This has helped Motherson gain new businesses and helped it maintain a healthy order book. Motherson continues to maintain a conservative capital structure reflected in a gearing of 0.8 times and a net debt to the operating EBITDA of 1.5 times as of March 2019. The debt coverage indicator continues to remain healthy, reflected in an interest coverage of 12.6 times. The liquidity position of the entity remains strong, supported by sizable cash and bank balances and low utilization of revolving credit and working capital facilities, even as cash flows are likely to remain impacted in 2021 owing to the COVID-19 outbreak. The credit profile of the company would remain sensitive to the duration and breadth of the COVID-19 pandemic and any further debt-funded acquisition undertaken by the company. The management is expected to continue to adopt a disciplined approach while continuing to evaluate further inorganic growth opportunities. The competition in the automotive industry remains high. Nevertheless, aided by its in-house product development capabilities and technical collaborations with Sumitomo Wiring Systems, Motherson has emerged as a preferred solution provider to its customers and has sustained a strong market position over the years. The company's product portfolio remains agnostic to internal combustion engines, hybrids and electric vehicles, thereby limiting any risk arising from a prospective transition towards electrical mobility going forward. Also, it does not affect in terms of even if the companies move from combustion engine to the electric engine or electric mobility, the parts or the components or the products this company manufactures will be utilized regardless of whether it's combustion based engine or electrical engine. Motherson derives 50% of its revenue from Europe and exhibits 65 to 70% approximate revenue dependence on European OEMs. So its major resources or revenues come from the European market. Thus, its business prospects remained exposed to cyclical demand patterns across global automotive markets, as well as the ability of its customers to maintain their market position or operating performance. Global demand for light vehicles, a key segment, was already expected to remain sluggish in 2020 amid weakening economic growth across the key markets. As the COVID-19 outbreak continues to worsen, global auto sales are expected to remain significantly weak, resulting in a negative outlook for auto parts suppliers. A relative prolonged period of curtailed automotive demand due to the consumers staying wary of large capital commitments is a negative trigger. Motherson's manufacturing footprint across global markets, coupled with its policy of order-backed expansion, continues to provide comfort, with the company likely to be in a position to support its OEMs by realigning its manufacturing strategy. The company's management has a track record of pursuing an inorganic growth strategy which is expected to continue. Most of the acquisitions undertaken by the company, almost 22 acquisitions since 2002, have been customer-backed, with the management being largely successful in turning around these entities. Motherson has been able to enhance its operational profile significantly over the years, as reflected by strong synergies within the company in terms of centralized procurement as well as a large product basket, which have helped Motherson remain cost competitive and a preferred solution provider for its customers. The track record of successfully turning around major acquisitions by the management as well as financial discipline exercised in acquiring entities provides comfort. The liquidity position of the entity remains strong, supported by sizable cash and bank balances and low utilization of revolving credit and working capital facilities. Even as the ongoing lockdowns across geographies in view of the COVID-19 pandemic is expected to impact cash flows over the short term, the entity continues to have sufficient liquidity to meet its fixed overheads and debt repayments. It remained modest at approximately 85 crores of repayment in 2021. The entity is also likely to lower its earlier planned capex of 2400 to 2500 crores in 2021. Stabilization of global automotive demand following the resolution to the ongoing COVID-19 outbreak and the macroeconomic environment will lead to a healthier than expected scale up in operations across locations. If the weakness in demand across global automotive markets is more prolonged than currently expected, it would adversely impact profitability and credit metrics of the company. Furthermore, any large debt-funded capex or acquisitions and its impact on the credit profile would also continue to remain a key monitorable. The impact of the proposed demerger of the domestic wiring harness business, which contributes approximately 8 to 9% of the consolidated turnover, along with associated debt and other obligations into a separate entity, would also remain monitorable. As of March 2019, the company had 170 subsidiaries, 3 associate companies and 4 joint ventures spread across the globe. Let us look at the key financial indicators consolidated over 2018 and 2019. The first values will be of 2018 and the second value will be of 2019. Operating income has increased from 56,293 crore to 63,522 crore over 18 to 19. The profit after tax has decreased from 2,121 crores to 1,985. Return on capital employed has also decreased in 2019 from 18.1 to 15.5%. The total debt compared to operating EBITDA has increased from 2 to 2.2 times. This is better. Interest coverage has remained almost flat at 12.6 compared to 12.5 in 2018. So finally, let us recap. Motherson, including its subsidiaries and joint ventures, is one of the leading manufacturers of automotive wiring harnesses, mirrors for passenger cars, and a leading supplier of plastic components and modules to the automotive industry. Its broad business portfolio includes wiring harnesses, mirrors for passenger car, injection molded products, module including dashboards, door trims, bumpers, blow molded components, liquid silicone rubber molded components, injection molding tools, precision metal components, and waste recycling systems. So this concludes my understanding and profile analysis of Motherson. Next, let's move on and look at the detailed consolidated financial statement, which includes the annual profit and loss account, balance sheet, cash flow statement, and quarterly profit and loss account. Let's begin our analysis of Motherson through profit and loss account. Let's look at the sales growth measure compounded over 5 years, 3 years, and the latest 12 months. This data has been sourced from screener.in, and I'll be also analyzing the peer group comparison, that is the competitive companies which are in that same group with Motherson, using a different data from a different source. So we'll have 2 different sources of data to compare this company. Let us look at the growth in sales over 2019. It has increased slightly from 63 to 65,000 crore, a 3.19% growth. But when we look at the 5 and last 3 years growth rate, that is from March 14 and March 16, we see a double digit above 15% of growth rate in sales. This is a good indicator telling us that the company's revenue through sales are increasing. That is, the company's products have continuous demand and they are managing to grow their revenue through increasing sales. The average operating profit margin seems to be quite low over the last 5 and 3 years period. As we saw in the company's profile, the company has a direct dealing with the OEM manufacturers, and therefore the profit margin is low, as the OEMs would try to squeeze maximum out of these small companies or out of these auto ancillary companies. Last 3 years and last 5 years on an average, the company's OPM percentage has been above 8.9%. Let us look at the individual values of the recent 12 months. It stands at around 7.7%. The cost or the operating expenses stood at around 60,400 crore compared to the 65,500 crore of sales done. In March 19, the margin was at 8.4%. So the operating profit margin seems to be low. When we look at the 5-year trend also, we see over the last 5-year period, the trend had always been below 9%. And we have to accept this as its standard OPM margin. When we compare it with its peer group company, we'll have to look at where the other group companies or how the other group companies are generating their operating profit, or at what percentage they are generating their operating profit margin, and thus we can compare it like to like. Other income percentage is contributing a very small portion as a percentage of total sales. Through other sources besides the operating income, the company can also generate gain through investments it does in shares, mutual funds, etc., if they have additional or excess cash lying with them. So in that sense, it is contributing very small portion of the total revenue generated. When we look at the depreciation percentage, it has been very flat at around less than 4% throughout March 16, 19 and the recent 12 months. And value wise also it is very stable and flat. So we'll have to see in the balance sheet how much assets the company has and calculate what percentage of the total assets or net assets is it getting is the depreciation being charged to the P&L account. But as of now, this is a low figure and we'll need to investigate as to how they are depreciating and what kind of assets it is holding by going into the balance sheet and looking at the footnotes. Company's raw material cost over the period has been declining as a percentage of total sales. That could also mean the company is generating higher sales compared to amount of raw material that it is holding. In March 19, the raw material cost was around 58% of the total revenue generated. Compare that with the employee cost, which has been increasing steadily. In March 19, the company is paying 22% of its revenue to the employees, and this would also mean that the company values its employees and therefore gives a substantial portion of its revenue to the employees. This seems to be a high percentage. We'll have to check how many employees the company has and what is the per employee sales that is being done. Company's interest expense as a percentage of total sales is also very low at 563 crores in the recent 12 months compared to 423 crores in March 19. It has been steadily increasing to 563 now, but as a percentage of total sales it was always below 1%. So on a total sales of 65,500 CR, the company's finance cost or the amount of interest it paid was just 563, a very small portion. So this would signify that the company's debt to equity position or the amount of borrowings or debt the company has taken would be small. When we check out the balance sheet, we'll understand it much better. Company's tax rate as a percentage of profit before tax has been about 20% throughout, and in March 19 and the recent 12 months it has increased to about 30%. In the recent 12 months it paid a tax of 735 CR compared to the profit before tax of 2300. In this particular analysis of tax percentage, we can also look at how much the company is deferring its tax payment or tax liability. Many companies show a tax paid of 735 CR, for example, in this case, and not pay this 735. In the P&L account they will show 735 CR, but in the cash flow statement the amount of tax paid in terms of cash outflow will be shown separately, and therefore we'll have to see what is a mismatch between the tax rate shown in the tax value shown in the profit and loss account and the actual tax paid in the cash flow statement analysis. So if someone wants to do that, they can check out the cash flow statement and look at the amount of tax paid in cash under the cash from operating activity. Interest coverage ratio stood at above 4 times throughout March 16, 19 and the recent 12 month. In the recent 12 month, the multiple has dropped to 5.1 times. The company paid a finance cost of 563 CR against the total EBIT generated of 2886 CR. That's a multiple of 5.1 times. I want all my companies that I invest in to have a good interest coverage ratio, that is, their operating margin or EBIT percentage or EBIT value should be higher by at least 4 times than what it is paying as finance cost. So this multiple is still good, but it has lowered from where it was in 16 and 19. Net profit margin throughout the years have been very low at below 5%. The company is working on a very low margin throughout these years. In the recent 12 months, the net profit margin was a very small 2.2%. So on a total sales of 65,500 CR, the company's profits were just 1,400, and that has also fallen from where it was in March 19 at 1,600 crores. Throughout, we see a drop in its profit margin. So the company is getting squeezed, its profit value is dropping, and therefore we have to understand what is causing this margin pressure on the company. We'll also need to look at the amount of cash it is earning through the cash flow from operating activity. That we will compare when we analyze the cash flow statement separately. The average NPM over the period of 5 years was somewhere around 3%. In the last 3 years also it was approximately around 3, and in the recent 12 months it has dropped below its averages of 5 and 3 years. So there is definitely some margin pressure on the company. Let us look at how the profits have been growing compounded over the recent 12 months, through 3 years, and through the last 5 years. In the last 5 years, the profits have compounded at a rate of around 16.1% from March 14 to March 19. And in the last 3 years, it has fallen below 10% of growth rate from March 16 to March 19. And in the recent 12 months, the profit has fallen from 1,600 to 1,400, a 12.2% drop in its profit over 2019. So the company is feeling some kind of profit pressure or profit margin pressure over the years. Moving on to the market cap to sales ratio. This is a valuation ratio which would help us understand if we are buying expensive in terms of taking sales as our base value. In the recent 12 months, the total sales done by the company was 65,500 crores, and if someone had 20,000 crores with them, they can buy this entire company in the market, which is just a multiple of 0.3 times, which is a very good discounted value that we would be able to buy at current price. So on a total market cap, the company is doing a sales of 65,000 crores, a very high value. So we are getting at a decent valuation here. Even in March 19, the company's market cap was 47,000 crores, and the sales it was doing was of around 63,000. So it is doing more sales than what it is valued in the market. And in March 16 also, it was very near, its market cap was very near to the amount of revenue it was generating. So the multiple has dropped now to 0.3 from 1 times over the period, and this gives us a very good buying opportunity. We can see the market cap from March 19 to the recent 12 months has dropped considerably. That is from almost 47,000 CR to 20,000 CR, more than 50% drop in its price. The company has been a big dividend payer over the years. A major portion of the net profit was given out to the shareholders. March 14, 28.8% of the profits earned were given out as dividend. March 19, around 29.4%. So the company believes in paying dividend, and we can see the value in terms of growth in the amount of dividend it is paying throughout the years. As its profits are increasing, it's paying out more dividend also. Moving on to the valuation ratio, price to earnings. Through this ratio, we are trying to understand what price we are paying against the earnings done by the company. In the recent 12 months, the price earning multiple has come to around 14.1 times. That is, its price was 63 rupees in the market, and it was earning 4.50 rupee per share. That is a 14.1 time multiple between the earnings and the price. Compare that to March 19, where it was available at a very expensive and above my benchmark of 25 times, where the earnings per share was just 5.1 rupee and the price was 150 rupees per share. So we see the drop between the price in which was there in March 2019 to the current market price of 63 rupees as of 15th April 2020. So within 1 year, we are seeing an almost more than 50% of drop in price, although the earnings per share has not declined that considerably. As of today, we are getting at a good valuation of 14.1 times. We'll also have to look at the peer group companies where their price to earnings is trading at. Let us look at the average of 3 years and then compare it with the recent 12 months. So in the recent 12 months, we are getting at a steep discount to its averages of last 5 and 3 years of 37 and 34.6%. As I mentioned, all these data is sourced from the financial statement provided by screener.in. If you find any mistakes, do let me know in the comment section and I'll try to correct that in the next analysis. Moving on to the balance sheet analysis, equity share capital has been increasing steadily from 88 to 132 in March 16 to 316 crores in March 19, and the face value is at the lowest at 1 rupee per share. This is not of much significance until and unless the company is diluting or increasing or raising more funds through additional issuance of equity shares. Let us begin by looking at the profitability ratio or return ratios on different variables. Starting with the return on equity, that is how much profit the company is earning on the total shareholders contribution or net worth. March 19, the ROE fell below 15%, which is my benchmark. On a total contribution from shareholders of 10,963 crores in the business, the company had earned a net profit of 1,613 crore, which is a 14.7%. March 14 and 16, the company's ROE percentage was very healthy at above 25%. In March 19, that has seen a kind of a pressure. Let us look at the averages of 7, 5 and 3 years. Over long-term averages, we see that in the last 3 years, the amount of profit that was earned on shareholders' contribution has dropped substantially, yet it is above my benchmark of 15%. Over the long-term period of 7 and 5 years, the ROE averages are very good at about 20%. So what we are trying to understand from this analysis is that how the company has been doing over a long-term trend of 3 years, how it is doing in terms of short-term trend of 1 year, and a very near outlook as to what is happening currently in the company through the quarterly analysis that we'll do at the end of this session. Return on capital employed measures the total source of fund the company has, or all the money that the company has, either from shareholders or from borrowings, and on that how much EBIT it is generating or how much profit it is generating at the top line. In March 19, the company's ROCE was 16.1%, slightly above my benchmark of 15% again. On a total capital of 22,497 employed into the business, the company has managed to generate an EBIT of 3,623 crores. And we can see that the amount of EBIT has been steadily increasing from 14 to 19, as well as the amount of capital employed into the business has been steadily growing up. So this is the amount of funds the company has, either through contribution from shareholders in terms of reserves and surplus, as well as any additional borrowings that the company may have done. Although percentage wise, if you see, the ROCE value has dropped to 16.1 in March 19. Let us look at the long-term trend of 7, 5 and 3 years. Over the long-term period of 7 and 5 years, the company's ROCE percentage was about 20%, and in the recent 3 years, the average has fallen to 17.6. Return on total asset measures what is the total balance sheet size, or how much asset the company has, which includes all assets like fixed assets, debtors, cash and bank balance, investments, inventory, capital work in progress, goodwill, and each and every asset that the company owns. Or we can say what is the total balance sheet size, and on that balance sheet size what is the net profit that the company is earning. In March 19, the amount of net profit the company earned based on the balance sheet size was very low at 3.7% and fallen below where it was earning in March 14 and 16. So although the company's balance sheet size is increasing or total assets are increasing, the profits are not increasing that substantially over that same period of time. Debt to equity ratio is a gearing ratio which measures how much debt the company has against the equity contributed by the shareholders. So in March 19, the multiple has gone above 1.1 times. Although if we look at the trend, it has dropped from where it was in March 14 at 1.6 times, meaning the company's debt was 4,840 CR and the equity contribution was just 2,900 CR. As the company's debt has been increasing, so is its equity into the business. That is, it is earning or retaining more and more profit into the business. And in March 19, the debt is slightly higher than the equity contribution. I would want my companies that I'm investing in to have a debt to equity ratio below 1 until and unless these companies are a high growth companies. Even if the debt to equity is above 1 times, we can also look at how the company is managing this debt via interest coverage ratio, which we checked out earlier in the profit and loss account, where it showed that the company's interest coverage was above 5 times, which is above my benchmark of 4 times. So if you don't understand any of these ratios, do let me know in the comment section, or else you can also watch my earlier videos in which I have explained in great detail about each ratio, what it means and how to understand these ratios. All ratios are important in a sense that we can try and find out red flags or potential problems from each of these ratios separately. And although it will take 1 hour to go through all these ratios, it is worth the amount of time you spent, because if you do not understand these ratios and invest your money, there is a high probability that you will lose a substantial portion of your capital. Equity is contributing around 25% in the business, whereas debt is contributing around 27%, slightly more than the equity, which we already have seen in the debt to equity ratio. And if you look at the trend, the amount of equity contribution in the business is growing from where it was in March 14 to March 19. Here, in terms of debt contribution, it is decreasing. This gives us a good understanding that the company's debt percentage is decreasing and the equity contribution is increasing. So this is a good sign. Although if you look at the overall debt to equity position, we see that it is slightly at above 1.1 times. So the total percentage of debt and equity into the business is 25 and 27%, which works out approximately more than 50%, and the balance is the other liabilities or current liabilities of the business, which we'll look at in the later part. The price to book valuation ratio tells us how expensive or cheap we are getting this company based on the net worth or employed into the business. In the recent 12 months, the price to book ratio has fallen to 1.8 times, below my benchmark of 2.5. Earlier in 16 and 19, it was trading at a very expensive 8.3 and 4.3 times. This is not the time to buy into the company. Even in March 19, the multiple was very high at 4.3, which means that the amount of shareholders' contribution in the business was 10,900 crores and the company was valued 4.3 times higher in the market at 47,200 crores. Now in the recent 12 months, because the market cap has fallen and the net worth which we are taking from 2019 is remaining the same, and therefore we're getting at a good multiple of 1.8 times. This is the right time to enter into the company if we are comfortable with all the ratios that we are checking out. Debt to net profit ratio measures how much debt the company is carrying against the net profit it is earning every year. In March 19, the debt was around 7 times higher or 715% more than the profit it earned. So this is a high multiple. Anything above 6 or 7 or 8 times will be considered higher. That is, the company has taken a total debt of around 11,534 crores as of March 19, and against that its profit is just 1,600 crores, which is a 7.1 times multiple. I would want the company not to exceed its debt by more than 6 times its profits. This way we can understand how efficiently the company is managing its debt, and on that debt what kind of profit it is earning. At least in March 16 we see a low multiple of 4.7 times, whereas in March 14 the multiple was slightly higher at 6.3 times. So the company's debts are increasing but the profit is not increasing that substantially. So we want to see a change in this particular portion of the ratio. Net block percentage measures the amount of net assets the company has out of the total balance sheet size. The net block is calculated by removing depreciation or accumulated depreciation from the total assets of the company. If you don't understand this, do a little bit of research on Google about accumulated depreciation and gross block or gross fixed assets. In March 19, the company's assets or fixed assets or net assets were very high at 42.5%. I don't want the company's assets to increase above 40% of the total balance sheet size. As the company deploys more and more money in fixed assets, that is basically blocked for a longer period of time. And although they do contribute in the overall manufacturing process, but they are still an idle asset. So company's total net block or net assets have been increasing from March 16 to March 19. It has increased by almost 100% over a period of 3 years. This could be due to the company's acquisition of other companies in the recent 3 years, which we saw already in the company profile. The company has increased its assets over the years by inorganic growth or through acquisition of other companies. We can see its overall total balance sheet size has also increased substantially, almost by another 100%, from 19,900 to 43,000 crores through March 16 to 19. And we see an increasing trend in terms of percentage also, that is how much assets the company is having in its total balance sheet. Next, we'll also have to understand how much depreciation on this total block is being transferred to the P&L account every year. On the right hand side, I have added in a depreciation percentage of the total gross block. That is how much total assets the company had before depreciation. On that, the company's total assets, that is gross block or gross fixed assets, were 20,400 crores as of March 19. From that, the depreciation of those assets were of around 2,000 crores, which translates to around 10%. So basically, after removing 2,058 CR from 20,481 CR, we get the net block of around 18,423. So on this total gross block, what is the percentage that was charged to the P&L account? This we are trying to understand. And we are trying to understand if the company is manipulating its depreciation that it is charging to the P&L account. As we see from March 16 to March 19, the company's assets have increased from 8,200 to 20,400. On that, the depreciation charged has also doubled over the same period. The depreciation rate on the gross block has decreased to 10% in March 19 from where it was in March 16 at 13.2%. So in all of these ratios, we are trying to find potential problems or red flags or any indication which will alert us and tell us not to go in for this company if there is any manipulation going on. Continuing on, let us look at how much capital work in progress was going on into the business. This is the work going on of capital nature, that is development of fixed assets. In March 19, around 1,000 crores of fixed assets were being developed, which will get added to the overall net block of the company, which we saw in the earlier graph. This is just 2.5%, which has moderated down from March 16 where it was 7%. So on a total assets of the company of 43,000 crores, only 1,000 crores of work was going on of capital nature. In terms of cash holding, company has around 3,500 crores of cash on its balance sheet of the total 43,000 crores. That is 8%. We don't want this to exceed 20% of the total balance sheet size. Over a period of years, we have seen a flat trend in the amount of cash it is holding, although it has increased from where it was in March 16 by almost double. Company's investments in mutual funds, shares, or any kind of investing activity were just 2% of the total assets. So the company is not putting a lot of its money into investing activity. In fact, it feels it should hold more cash, and that is why in the earlier chart we saw the company's cash holding was around 3,500 CR. In terms of investment, it is very low at 855 CR in March 19 compared to the total balance sheet size. Looking at the debtors percentage, that is how much were the customers from whom the company had to collect payment against the total assets, that occupied around 14.2%, a reasonable value compared to where it was in March 16 at 23%. It has definitely improved to around 14.2%. The total assets have increased to 43,000 CR, and the total accounts receivables or total payment to be received from the customers as at end of March 2019 was around 6,100 crores. I don't want these values to exceed 30%. That is, in no year the company's payment to be collected from customers should exceed 30% of the total balance sheet size. In terms of debtors turnover, which signifies how much payment was to be collected from the customers against the current year's sales, in the earlier graph we saw against the total balance sheet size the debtors should not exceed 30%. The same rule applies here. We don't want the debtors or accounts receivables or payment to be collected from the customers to be exceeding 30% in any 1 year's sales figure. So in March 19 it was just 10%, and throughout the years it has always been below 15. And if you look, 63,000 crores of sales done, against which only 6,100 crores of pending payment in the balance sheet, which is a good value. And that payment it is collecting in within 35 days in March 19, and it has improved from where it was in March 16 and 14 at 39 and 46 days. So company is efficiently collecting its payment from the customers and also keeping the value to be collected against the sales and the balance sheet size as low as possible. In terms of current ratio, that is the company comfortable enough to pay off its current liabilities, that is those liabilities which are going to arise in the current year, against the current assets it is holding. It is at 1.1 times, and throughout it is above 1 times, meaning the assets were always higher, or the current assets, those assets which it can sell within the current year and pay off the current year's liability, were always more, and that we can see throughout the trend. And that is what we should look for, a comfortable liquidity position. If the liabilities exceed the assets, then that creates a problem, in the sense that company would need to dip into its internal resources to arrange for payment of these liabilities. The amount of inventory holding in the company of the total assets were just 10.8%, and in March 16 it was 11.5. That is the amount of inventory it was holding in its balance sheet. Inventory is the total amount of raw material, finished as well as unfinished, which is still going under process of manufacturing or still lying in the godown, and we don't want a very high inventory in the company. So it is occupying just 10.8% in March 19, and we have to look for a value which is quite flat throughout the years, which signifies that the company is holding enough inventory against its total assets. In March 19, the total inventory was 4,600 crores, which occupied around 10% of the total assets. And this inventory holding should not occupy a major portion, as that entails a cost to the company in terms of storage, loss due to fire, theft, etc. Inventory turnover, again we are comparing both the inventory with the total assets and with the sales. Against the total inventory holding, the company's sales were around 13.6 times higher in March 19, and if you look at the trend of 14 and 16, it seems it is in that particular range itself. So this shows efficiency of converting inventory into sales. The higher the better. Moving on to the cash flow statement analysis, the amount of net profit declared and how much cash is flowing from the operating activity of the business. Here what we are trying to understand, this is a very important ratio. You have to definitely understand this thoroughly. The company can show any kind of profits, but is it receiving cash against that profit? That is very important to understand, and therefore we have to thoroughly analyze the cash flow statement separately. If someone is interested and want to do more research, then they should definitely look at the cash flow statement analysis. In March 19, the company had declared 1,600 crores of profits or net profits, against which it received a cash of 4,300 crores, which is around 167% higher. In March 16, it was 69% higher, and in March 14, the cash coming in was 2.5 times or 252% higher than the net profit declared. So earlier when we looked at the net profit margin, we saw how low it was, around 2% or something. Now if we want to also look at the cash profit margin, so one, we have the net profit margin through the P&L account, and we can also look at the cash profits margin. So we can take the cash value of 4,300 crores and use it against the sales done by the company, and through that we can calculate the cash profit margin. So we have the total cash of around 4,300 crores coming in to the business, and against that the amount of sales the company has done is 63,523 crores, which translates to around 6.7% of cash profit margin in 2019. So this way we can calculate the cash profit margin and net profit margin. If we look at the long-term trend, the company had always a positive cash or more cash coming in through operating activity than the profit declared. Over the period of last 3 years, the cash flowing into the business was around 11,300 crores against the net profit of 4,000. In last 5 years, 16,900 came in through cash against 6,900 crores. That is 145% more cash, and 7 years it was 160% more. So we are seeing throughout the years the trend is that the company always receives higher cash than the net profit, and this is what I'm trying to look at in the companies that I'm investing in, that I want the companies to generate higher cash than the profit it is declaring. In this chart, I'm trying to understand how much cash the company has earned and how much it is putting it into the investing activity part. In March 19, 77% of the cash earned through operations has gone into investing activity, This activity would include buying of fixed assets and buying of mutual funds, shares, etc. This also includes buying and selling net, how much the company put into investing activity. And if you look at the trend of March 16, it was somewhere around 87% of money earned through operations put into the investing part. Even in March 14, 51% has gone into the investing activity. If you look at the long-term trend of 3, 5 and 7 years, in the last 3 years, 111% of the cash earned means the company has put in an additional money into the investing part than what it earned through the operations. And if you look at the long-term trend, the company has always invested heavily into either buying of assets or investing in mutual funds, shares, etc. Whatever is the investing part, it is putting almost all of its cash into that portion. And to do that, if the company is earning around 11,300 crores, how the company is putting more cash into investing than what it is earning through operations is by way of additional borrowings through external sources or through dipping into its reserves. I generally want the company to not invest more than 50% of whatever cash it is earning over the long term into investing part. This is because even if the company is showing high growth and it's not earning profits, then that creates a problem for the company in the long run. Let us look at the price variation over March 16, March 14 and March 12 values. That is going back 3 years, 5 years and 7 years, how the price has moved from there. So I have both the CAGR growth rate, CAGR compounded growth rate over every year, and the total drop or gain in the price from those years. So in March 16, price per share was 118 rupees and that has fallen to 63 rupees. That's a degrowth compounded 18.9% every year, and to total drop of approximately around 46.7%, which I explained earlier how the prices have dropped over March 16 and March 19 values. So the total drop from March 16 is around 46%. So we are getting it at a discount of almost 50% from where it was in March 16, and a 18.9% CAGR degrowth every year from March 16. From March 14, the total drop is approximately around 16%. So we are even getting this price at lower than where it was in March 14. From March 12, 7 years back, the price is up by 157%. So the price is up by 157%, and every year since last 7 years it has grown compounded at the rate of 14.5%. 7 years back the price was approximately around 24.5 rupees. These prices are adjusted prices for the corporate action. Corporate action would include your bonus. If we look at the price variation, we are getting it below the March 14 value by 16.6%. So we're getting at a good discount to where it was around 5 years back. And if we look from 7 years back, we see that it has gained by just 1.5 times. So this is a good price growth, and at current price, if somebody is buying, they can expect that they are not buying very expensive. Let's recap the valuation ratios. Price to earning is approximately 14.1, a reasonable value. Price to cash is 4.6 times. Price to book is 1.8 times, and market cap to sales is 0.3. All are trading at a discount. All the ratios are trading at a good valuation. Let's move on to the quarterly P&L account analysis. Beginning with the sales growth YOY and quarter on quarter, sales had a degrowth of 1.7%, and over the 1 year back it has fallen by 4.9%. So in the near term or the recent quarter analysis, we see that there is a degrowth, or the revenue from sales has fallen both YOY and quarter on quarter. Profits have also seen a degrowth at a higher value of 30.5% YOY and 29.7%. So in the near term, we are seeing a lot of margin pressure on the company's profits. In December 18, the company had earned 389 crores as profit, whereas in December 19 quarter, the profit fell to 271%. In September, it was 385, a better value, but again, it has seen a 29.7% over the previous quarter. So both sales and profits are showing negative trend in the short term. Net profit margin in December 19 has dropped to 1.7%. Is very small, a very low margin earned on the total sales of 15,600 crores. The company's profits were just 271 CR, and the trend overall seems to be dropping from 389 earned in December 18 to 271 crores in December 19. So company in the short term has seen a degrowth in both in sales and its net profit. So this concludes my analysis of the company's financial statements. Let's move on and look at the peer group analysis of Motherson Sumi with its peer group companies. In the peer group analysis, I am comparing Motherson Sumi with WABCO India and Endurance. These are all auto part manufacturers. The market cap of Motherson is at around 19,900 CR and WABCO's is at 11,938. Endurance Technologies market cap is 8,300 crores. Let us look at their net worth. Motherson's current net worth is 10,000 crores. Compare that with WABCO and Endurance. They are considerably smaller at around 1,780 and 2,500 crores. So they have got a high price to book multiple because the difference between their market cap and net worth is huge. Motherson's current price to book is 1.8 times. Its market cap and its net worth are very nearby each other. WABCO's is at 6.7 times, a very expensive multiple. Endurance is quoting at around 3.2 times its net worth. In terms of price to earnings, Motherson is at 12.4 times. Endurance is available at 16 times its earnings, and WABCO India is expensive at 42 times its earnings. Both Motherson and Endurance price earning has fallen below 25. Although price to book wise, Endurance is expensive at about 2.5. The PEG of the last 5 years is 0.8, which means the price earning we are paying for this company, against that the growth in the profits over the last 5 years is higher than the earning multiple that you are paying, which we will look at in the profit growth of the last 5 years. WABCO India is expensive in terms of PEG at 2.2, meaning the multiple price earning 42 times that we are paying. Against that, we are not getting a high growth in the earnings. Endurance is also available at a good PEG of 0.9. Compared to the price earning multiple of 16, the profits in the last 5 years are growing at a healthy rate. In terms of price to operating cash flow, like price to earnings, we can check price to operating cash flow also. This is quoting at 4.6. Motherson is quoting at around 4.6. WABCO is very expensive at 79.6. This ratio indicates that the company is receiving less cash than what it has shown as earnings of 42 times. Endurance is available at 8.9 times its operating cash flow in terms of market cap. So again, we have to buy below 25 times for both price earning and price to cash. Price to sales ratio, that is how much was the market cap and how much the sales the company was doing in 2019. Most of these ratios are of 2019 unless and until I mention about it. Motherson sales were higher than the market cap. We're getting it at a discount to its sales. WABCO is expensive. Market cap is 4.2 times higher than its sales, whereas Endurance market cap and sales were very nearby at 1.1. The enterprise value to EBITDA ratio signifies what is the total market value of the company, that is the enterprise value, divided by the EBITDA, that is operating profit that the company has made in 2019. Compared to the EBITDA, the market cap for Motherson Sumi is 5.2 times higher, WABCO is quoting at 27 times higher, and Endurance is quoting at around 7.5 times its EBITDA. So this is a new ratio that I have included here. Also, another thing to note is that this ratios I have picked up from another source. This is not from screener.in. These ratios I have picked up from another website, and these ratios are not from Screener. Motherson's current closing price as of today is 63 rupees. WABCO India is trading at around 6,200 and Endurance is trading at around 590 rupees. Let us see how much it has fallen from its 52-week highest point and currently at where the price is, it has to go up 158% to reach its 52-week highest point. There could be some discrepancies between what I am looking in terms of peer group analysis and when I did the financial statement analysis, because the data source is from two different websites. When I was doing financial analysis, the data source was Screener, and when I'm doing peer group analysis, the data source is Tickertape. WABCO current price to 52-week high is around 10%. So the 52-week highest point is around 10% away. So this company has not fallen much from its 52-week high. Endurance Technologies has to move 110% to reach its 52-week highest point. Let us look at how far away the price is from the low it had made in the last 52 weeks. Motherson Sumi has moved up 30% from its lowest point. WABCO has come up 26% from the lowest point, and Endurance Technologies has moved 4% up from its lowest price it had reached in 52 weeks. So Endurance Technologies has seen the lowest movement from its 52 weeks low. Let us look at the 1-year return given by these stocks. Exactly 1 year back, what was the price and how much it has gone up or fallen down from there. Motherson Sumi has fallen around 59% from 1 year back price. WABCO India's price has not changed. Endurance has fallen 50% from its 1 year back price. So both Endurance and Motherson have seen a huge fall in their share price from 1 year back. So if somebody had bought 1 year back, they would have seen a negative 59% in their portfolio for Motherson. Let us look at the growth in revenue or sales over a period of 1 year, that is from 18 to 19, and also project the growth rate of the last 5 years. Motherson's revenue over 2018 has increased by around 12%, whereas the 5-year growth rate is at 15.9. As I mentioned, there could be differences between what I'm looking at here and what I analyzed during the financial statement analysis. WABCO's 1-year growth is 9.4 in sales and 20.8% in terms of last 5 years. Endurance has seen a double-digit sales growth over 2018 as well as from 5 years back. I don't have the 3 years data as that is not provided by this particular website. Let us look at the profit growth rates over 2018 as well as from 5 years back to 2019. So the projection is from 2018 to 2019 and from 5 years back to 2019. Motherson Sumi has seen a degrowth in its profit from 2018 to 2019 by 6.8%, whereas from 5 years back it's been compounding its growth in profits at the rate of 14.7%. WABCO has seen a positive growth rate in its profit of 3.6, and from 5 years back it has been growing at 19.2%. Compare that with Endurance, that's growing at 19.4% over the period of 5 years. Motherson Sumi's operating cash flow has seen a growth of around 32% from 2018 to 2019, whereas WABCO's cash has seen a degrowth of almost 50% from 2018 onwards. Endurance has seen a 25% growth over 2018's operating cash flow. So both Motherson and Endurance has seen a positive growth in their cash earnings. Like growth in profits or net profits, we should also see a growth in the cash flow from operating activity. If we look at the 5 years growth rate in terms of cash, Motherson has seen a 9.9% growth, Endurance 10% growth in its operating cash flow from where it was 5 years back. These are all CAGR growth rates. WABCO has seen just 1% growth rate. So in terms of cash coming in or cash flows, WABCO India is not doing that good. Return on equity in 2019 was around 15.5% for Motherson, 17% for WABCO, and Endurance generated around 20% of ROE. Compare that with the 5 years average return on equity. Motherson was earning approximately around 20% on an average, whereas WABCO at 18 and Endurance at 21. So we can see how Motherson compares with the other peer group companies in terms of generation of profits for shareholders. Return on capital employed for Motherson was around 10% in 2019 compared to WABCO generating around 16 and Endurance 17%. And last 5 years the average ROCE for Motherson was around 13% compared to 17% for Endurance and WABCO. So both these companies are generating above 15% of ROCE as well as ROE. Motherson has some pressure in terms of amount of capital it has employed and the corresponding EBIT it is generating. Motherson's balance sheet generated around 5.2%, or all the assets taken together has given a 5.2% return. Compare that with WABCO and Endurance, they are in double-digit growth rate. 5 years average ROA is 7.1 and the other two companies are generating above 10% of ROA over the period of 5 years. So both these companies are doing better in terms of ROA. Net profit margin for Motherson is very low at 3.3 compared to WABCO and Endurance. Again, even if you look at the averages of the last 5 years, there too it seems to be the lowest compared to WABCO and Endurance. But WABCO's cash flow was not that good compared to Motherson. We can say that although Motherson's net profit is low, its cash profit margin is somewhere around 6.7% that we checked out when we were doing the cash flow statement analysis. Let us see how much operating cash flows these companies have received against the net profit declared in 2019. Motherson has received 167% more cash than the net profit declared, whereas WABCO's cash is almost 46% short of its net profit. Endurance has received 87% more cash than the net profit declared. So Motherson is showing the highest cash inflows in 2019 against its profits. So this gives me a lot of confidence here. If you look at the debt to equity ratio percentage wise, debt is 105% more than the equity. That is, the debt to equity ratio in times would be around 1.05. That is, debt and equity is almost equal as of 2019. WABCO is a debt-free company, whereas Endurance debt to equity is just 0.28, or we can say 28% of the equity. We don't have the interest coverage for Motherson Sumi here, although when we analyzed in the financial statement, it was somewhere above 5 times. WABCO's interest coverage ratio is not there. Endurance, the interest coverage ratio here is of 2019. This is not up to date. So Endurance 2019 coverage was somewhere around 53 times its EBIT. The data here would be a little different from what I analyzed earlier in the financial statement, where I got the data from screener.in. The current ratio for all the three companies is above 1 times, which is a comfortable zone. Promoter holding for all the other three companies is high at above 50%. Motherson's promoters have pledged approximately 5.7%, a low value, and it should not exceed 20% of the promoter holding. The other two companies are pledge free. These are the new ratios that I've added, where we are looking at the foreign institutional holding, domestic institutional holding, DIIs, and mutual fund holding of shares in these companies. Foreign institutional FIIs are holding 16.4% in Motherson Sumi, DIIs are holding around 12.6%, and mutual funds are holding around 10% in Motherson Sumi. These percentages will need to be rechecked because this is for the first time I am sourcing data from ticker tape. So if there is any mismatch or discrepancies, please let me know in the comment section. WABCO India's shareholding for FIIs and DIIs as well as mutual funds are below 10%. In Endurance, FIIs are holding around 16% and DIIs and mutual funds are holding 6.9 and 5.3%. So this is the shareholding of the total shares of the company which are being held by these different institutions. Looking at the debtors to sales percentage, all these three companies are within the comfort zone of 30%. Although WABCO's debtors to sales percentage is high at around 25%, compare that with Motherson at only 16%, meaning the amount of payment to be collected from customers were 16% of 2019 sales. Finally, let us look at the cash holding of these companies. Motherson Sumi is holding around 3,600 crores as cash in its balance sheet, compared to WABCO holding at around 863 and Endurance at 573 crores. In terms of capital expenditure of 2019, the amount of work going on in building new assets, Motherson Sumi is expanding has done a capital expenditure of 2,700 crores. WABCO's capital expenditure is very low at 119 and Endurance at 714 crores. Let us look at the debt position. Motherson's total debt is 11,534 crores. Earlier we saw the total net worth or total equity at around 10,000 crores and the debt to equity was slightly above 1 times. WABCO is a debt-free company and Endurance debt is 731 crores. The dividend yield at current market price with last year's dividend payout was around 2.4%. This is the yield or returns that an investor can expect based on current market price. The other two companies are giving a very low dividend yield of below 1%. So this completes my analysis of Motherson Sumi with its peer group companies. Let's move on and look at the technical chart. Let us analyze the technical chart of Motherson Sumi. This is a weekly chart and I am using the relative strength index oscillator to understand whether this particular script is oversold or overbought. Based on that, I will buy or sell. Here on 5th October 2018, the RSI red line had gone below 30. This was the time to buy, but the green line was still above 35. My criteria is that both the lines should be below 35 and one of the lines should be below 30 minimum. So here, although one of the line has fallen below 30, the other is still above 35. The numbers for both of them are 29 and 38. So one of the green line is above 35 and the red line is below 30. So this is not a time for me to buy. Moving on, there was never a time when the green line, after this there was never a time when the green line went below 35. So there was never a buying opportunity here at this price point. Moving on from here, on 15th March 2019, the relative strength index line crossed 50 mark and therefore it automatically resets my buying. Now I have to again wait for the one of the RSI line to go below 30 and the other to go below 35. So both should be below 35 and one should be below 30. So as we move on, the next buying opportunity where both the lines came below 35 was on 16th August 2019. But here too, if you notice, one of the line is not below 30. Once a reset occurs here above the 50 line, either of the line should be below, one of the line should be below 30 and the other should be below 35 minimum. Going ahead, there was a reset again here, so we have to again wait for the RSI to fall below 30. And although here on 13th March 2020, one of the line crossed below 30, the other was high at 42. The green line was at 42. Therefore, this was not a buy even at 63 rupees. Here we need to have a lot of patience to wait and buy at the appropriate moment when the RSI indicates to buy. Moving ahead, on 3rd April 2020, we see that both the lines were below 35 and one of the line had dipped below 30, and therefore this was the correct moment to buy into the script. Either we buy when both the lines go below 30 or one of the line is below 30 and one of the other line is below 35. So that is my criteria, that to buy I need both the lines to be below 35 and one line at least to be below 30. I have not explained this in my previous videos because in my previous videos this kind of situation never arose. So moving on, we had to buy at a closing price of 54.7. This was the starting point to start buying into the company. From here on, I'll start buying only on support and resistance lines. So I see a support at 63.5 when the RSI had gone below line 30. My next support line is at 95.4 where I can also buy here. My next support line is at 95 rupees and going down it is 40 and 31 rupees. So these are the 4 levels that I have to buy into this company. So the buying opportunity started on 3rd April 2020 where the price was 54 rupees. From here we had to buy, and going up 63.5 was the support and resistance line. Next after that is straight away at 95 rupees. I do not recommend anyone buying above 95 rupees. 95 was the time when both the lines reached below 35. This was my support line. Looking at the downside, where we can buy into this company is at 40 rupees, 31 and 26 rupees. If it does fall down from here on, which looks unlikely, so we have to buy judiciously between these gaps. Next, let us move on and look at the intrinsic price calculation. Let us look at the intrinsic price projection. I have 4 levels, and these levels are based on historical growth rates of sales, profits, cash flow from operations, balance sheet, and so on, based on 3 years and 5 years of growth rate, and that growth rate is projected over the price to come to these valuations. These valuations are very different from the technical analysis I did earlier. The current market price is 63 rupees. Even from this price, I see an upward movement of price to 113 rupees and 173 rupees going up. Although these are buy levels, but these are just projected levels. So either we go with the technical part or the fundamental, or we can take both into consideration and come to a price point from where we can start buying. But as we saw in the technical analysis, that our buying would never start above 70 rupees. Our buying would never start above 70 rupees because RSI would not allow us to buy. None of the lines were below 35. Very recently, we got an opportunity where both the lines came below 35. So that was the price point to start buying into. So we can take this as our projection for the upward moment in price. And from the current market price of 63, I see an upward gain of around 79.5% and 174% if it reaches 173 rupees. These are just the projections. So based on these price points, we can consider the lower 2 price levels for taking an exit from the stock. There is a huge variation between the fundamental and the technical chart, and therefore we have to take a midpoint. So we have to consider where we want to buy depending on whether the technical is giving a good indicator or not. So this concludes my detailed analysis of Motherson Sumi. If you have any comments, queries or questions, do write in the comment section and let me know. Thank you for watching this video. Dhanyavad.